like a daddy Mac. Dang's 30 years got our way, trading life and markets every day. Rusty's chained to the mines, digging deep day by day. But when Option Omega releases new features, he's free to come out and play. Option Omega, you're trading home, where every move makes you feel less alone.
Good morning, everybody.
Morning, Troy.
Good morning.
Good morning, everybody.
Good morning.
Another day. Markets in turmoil. Down 16.
Oh,
It is the bloodbath out there. An absolute bloodbath.
Bloodbath, folks. Yeah.
so what happened with this debt upgrade?
The what?
The debt, debt downgrade, really. The debt downgrade yesterday.
Oh, you buy the dip.
Okay.
Massive.
You buy the dip. You buy the dip. That was yesterday was one of the more frustrating days because one of the things I feel like is really important with like momentum, like is volume, but tempo more than even volume, like tempo.
Okay. What do you mean when you say tempo, Troy? What do you mean?
So there are days when you buy the dip.
Mhm.
And people buy the dip. I've seen plenty of days, we all have, where it opens down 30, 40, and it's immediate buy, like aggressive buy.
Right.
Yeah.
This was just one tick at a time up all day.
Yeah.
It was like there was no panic at all. It's just kind of just buying it. Didn't really go down much, just slowly just going up.
What's that death by 1,000 cuts? Just
That's right, paper
slowly.
cuts. It is.
Yeah, no respect. I mean, what did VIX get up, Troy? Was it up like a couple points?
I don't think it got to 20. I think it got to like 19 something.
Oh, did it get to 9? Oh, yeah, it did get to 19.
So. 19.
Yeah. We opened at 19, around 1920, and then it just.
Yeah.
That type of market to me is the worst because in some ways it's like the healthiest because they just there's no fear. It's just like I feel. I mean, we're jumping right in, but let me just show this real quick.
Oh yeah.
I
Spoiler alert.
Spoiler alert. This is yesterday's range, right? So we opened this right here. We got to 58.92 in the overnight session yesterday, the day before yesterday. And then we opened, and they call this a P formation, and you can kind of see it where it's just the line and then the distribution there.
Yeah.
And basically, I mean, we're right there where we were, and we're in Friday's range, and we're just kind of sitting here. This is like a consolidation, and short of news happening, options of all risks. We're not financial advisors. Short of news happening, I look at this and I say, we're probably going higher. That doesn't mean we're going to like aggressively go higher, but like if you think of the market as an auction,
which it is.
Below,
Yeah,
it is. We got below Friday's range on the open. We opened. I mean, this is literally this little arrow is the opening tick. So we opened at the bottom, and we quickly got back into range.
Yeah,
and then we just stayed there all day. And these prices down here, people did not see as valuable, did not see as fair value. Prices right here, people see as fair value, and so it's trading right here. It's about as simple as that in my mind.
So there wasn't much volume, Troy, at the 5,900 level yesterday?
No, there wasn't. And that's a good catch. So if you zoom in here, I mean, we opened and basically 12 ticks at the bottom.
Wow.
12 contracts at the bottom.
That's it. Okay. So zero interest at that level.
That's right. And you see it. You can see it as it's going up. Volume's building as it goes up.
Okay.
And then You get to the point here where there's a lot more volume at these levels.
Oh yeah.
And so, it's just a good quick way to remember, like, well, why is it doing it? The market's rigged. Well, no, it's just because people think prices right here are fair.
Period.
And it goes both ways. That's why we can't get above it right now. Because people think 6,000 is too expensive. I mean, that's basically it until they don't,
Yeah.
And so anyway, I think it's interesting. I think it's an interesting.
It's slow news week. You got the 3-day weekend coming up. I mean, sure, there's always that possibility something can happen, but I think it's hard for traders to trade what's in front of them, right? Instead of, you're looking at this and you're basically saying, looks like a consolidation or a range bound week, but it's that this could happen or that can happen, and you're like paralyzed. Whereas, when you think of some of the what the theme is this week, double calendars. If you said, is this a good week? Does this look like a good week just from a subjective double calendars? Quoting the great Sylvester Stallone from Philadelphia, absolutely.
Oh, absolutely.
Yeah, absolutely. Right. I mean, all you need is Matt. I mean, isn't one of the main for the DCs having VIX tick down at the open? Would you say that's one of the main staples for DCs? So yesterday it would, but they're not put on. Sometimes you can put them on later. Is it still going off of the opening? Do you want the opening VIX to be down?
A lot of people do DCs. There's people who do it that way, but I think most people do DCs just totally mechanically, and they like
without a VIX thing.
Yeah, I mean, you can test them with VIX, but their results over time are usually consistent enough that people, like if you're testing a premium selling strategy and there's a huge difference between vol compressing or expanding based on how cheap or expensive the spread is, I would say that that's the standard for premium selling or premium buying. But DCs, because they're so unique, I mean, they can win in, like you said, is this a good week for DCs? Absolutely. I would say every week can be a good week for DCs, unless it's a holiday week, which we actually have coming up. But
I just look at range bond. I look at the smaller candles.
Yeah.
And I look at the premiums high enough, like at 18, when you look at the break evens on calendars or double calendars, you're getting quite a bit of room.
You nailed it.
When you start looking at calendars at a 12 VIX, even though I love calendars at a 12 VIX from the volatility perspective, you're not getting those break evens that give you, whereas 18, it looks good from a lot of angles.
Yes.
Right.
Because I think you said something super, super important in that the most, maybe not the most important, but I'll just say it like this. DCs and sticky VIX are best friends. And so in 2022, Option Omega started. We launched in March. Daily options on the SPX started in May. That whole year, the market was down. It was a grind down market. It was Florida on December 27th at the beach for DCs. Perfect weather. The crowds are slightly down. It was great because sticky VIX, DCs can, as most of the people watching this who have traded them know, DCs can die in a couple ways. And usually the worst deaths are when the vols contract to where your longs get just absolutely wrecked. And sticky VIX, like to your point, Dan, like VIX did go down yesterday, but we're still at an 18 handle, right? So like the longs are not going to lose too much value if we stay at an 18 handle.
Right. And I think, I mean, to me, and I'm just taking a guess here, but I would be surprised if before the middle of July, maybe August, if we went, to me, it's like my range, I'd look, it's very similar to 2022. 2022, the range was like 18 to 31.
Yeah.
I'm looking for like 17, 30, 17, 31. Yeah. Could we hit 16? Yes. If we get to 12 or 15, yes, I would be a bit shocked. So I think we're kind of near that lower end, but again, similar to 2022 at an 18 VIX, they look healthy, right?
Yes.
It's like a cow, it looks healthy that you're getting nice break evens, but I think at an 18 vol, I'm not that concerned at 17, 18 right now that my longs are going to get destroyed.
That's right. And there's enough in the back tester, there's enough ways to test for vol crush on the longs, using short long ratio, using a VIX decrease, using there's a couple different ways to do it.
I like those.
And you can also skew the DCs to where there'll be usually would you say a vol crush, there's usually an upward action with a vol crush. So there's nothing to say that a DC has to be even deltas. And these are the kind of things the community has really dug into in the past couple of years. And a lot of them are advanced concepts, especially if somebody's new to options. But I think
that sounds like
that sounds like backtesting bird right there.
That sounds like a segue to me. I mean, John Travolta's looking at DCs going, "Oh my god!" So here we go.
Travolta.
Here we go. This is
that we're still in the SAC, right?
We're in the small account challenge.
That's right.
That's correct. And so just to remember, we talked yesterday, the idea is putting together a slew of trades that you can trade for a small account that you can have confidence in and that you can stay small. Confidence comes from managing your risk well. So with that being said, I give you Tuesday's DC. What are we looking at here, Matt? What is this DC?
Well, this is a 1-3. So you're selling a Tuesday strike on Monday. And we're putting it on Tuesday. We're selling a Wednesday strike on Tuesday, buying a Friday strike. So this is going to be a DC where the short leg expires 1 DTE. And we're entering it in the morning. And it's the same as yesterday, to where we have a little bit of slippage, some opening fees, and our only exits are time before it would expire and get assigned, and using leg deltas. So those are the exits, and it wins most of the time. And your winners your average winner is traditionally a little bit bigger than your average loser. And because it's part of the SAC, the small account challenge, it's one contract per trade. And so here's what's interesting. So yesterday I broke rule and I did some back testing live while we were on the show. And today I did something a little bit different. I ran 10 variations of this back test. And I ran it with the same deltas at 937, 933, 934, 936, 940. And the capture rates were 7.5, 8.1, 8.1, 8.9, 7.7. And then I ran it with different deltas. I did a 20-20, a 25-20, a 23-23, a 15-15, a 25-15, which was the original. And the capture rates were 8%, 8%, 9%, 7.5%, 8.1%, 8.7%. What I don't want you to do is pick out the highest capture and say, Matt, which one got this capture rate? Here's the point. That exercise, what I just did, 10 variations on a theme, okay? It is going to the point that this backtest is a good concept. This backtest is actually not curve fitted. There are better deltas and better times. The point is, when you have all these variations, 68% win rate, 60% win rate, 67% win rate, 58% win rate, 63% win rate, 66% win rate, 67, 63, 64, 64, all the different deltas, all the different minutes. What does that say? There's a concept here that's worth spending some time on. And because we have a world-class backtester, you can do that in a couple minutes. But here's the point. This expiration has worked in the past for years, and it's worked without curve fitting a magic minute, without curve fitting a certain delta. As I just mentioned, there are both better deltas and better times if you're that into precision. But the point is that there's something here.
Dan, when you look at this, the put is 25 delta and the short call is 15 delta. What are we looking at in that environment? What are some reasons that would work?
Yeah, I like, I mean, the general principle, at least that's what it looks like here. The general principle, if you're long Vega, is to be long delta. And this is definitely, looks like, I don't know what the Greeks would be at the beginning, but this would be, you're starting a little bit long delta because you're selling a 15 delta call, more room, bringing your put up a little bit. And so I think this would be something. Now, I would do this more like in the environment right now we're in. I mean, if you just, the environment we're right now, if I'm comfortable with, so I guess the question to me would be, when would someone on a long Vega trade like this? In what environment would you be more neutral to mildly short delta? And to me, the answer would be, hey, I'm comfortable with the VIX level. I'm comfortable where volatility is. And it's 1718 in the VIX. I don't mind being neutral to mildly short delta in the on my position, right? This delta here, 25 delta put, 15 delta call, might be more when we're in a, I'm just saying, just what hits me. If we're going up and the vol is kind of that 17, 16, where it just kind of grinds you down, a little bit extra long deltas will help. But to me, right now, I'm comfortable with 17, 18 VIX. I mean, it could go 16 or whatever, but I think, this is just a little bit long delta, I see, right? I don't think anything. What do you guys think? Just to give you a little more room to the.
Yeah. So I'm going to answer that by talking about a little bit broader concept that the Discord tried to trademark yesterday, which is the MEDC, the multiple entry DC.
Oh.
And here's the idea. These back tests are good, and they're good with different variations. And so what people were talking about in realizing is that with an automation platform like Option Omega, you could, if your allocation size is such that you were putting on 6 contracts or something, but you had 4 DCs that you liked, there's nothing to say you couldn't do 2 of one, 2 of another, 1 of the third, and 1 of the fourth.
I like that. Yeah.
And like to your point, Dan, a 15 delta, this same back test at 935, a 15 delta has both a higher win rate and a higher capture rate. And a 23 delta has about the same capture rate and win rate. A 20 delta has a higher capture rate, slightly lower win rate. But here's the point. If somebody had a bias, like to your point about where we are in the market, if somebody had a bias, or if somebody had a inclination, or they looked at their portfolio and said, I want to be longer delta or shorter delta, there's a variation of this that might get them there. And I'm serving up a Yappuccino, but I'm just going to make one final point on that. When we started backtesting in 2020 with OO, when we were live and everything, that fall was a really educational experience because we didn't know, people hadn't had a lot of data on how does PPI do, or how does CPI do, or how does FOMC do, or how do these various news events do with the back tests. And so I remember like blacking out, like actually with 1.3s, I think I've always blacked out CPI and PPI days and like various things. And I would get scared before a news event and whatever. I still see a lot of people. I saw people on Friday who were like, oh, that down cycle, we got a debt downgrade. I'm glad. I felt bad about DCs. I didn't put any on, and they were discretionary, and there's nothing wrong with that. I'm not picking on those people, and they may be right. Like DCs may be in for a rough week, but the DCs I put on Friday, they're up right now. We'll see how they turn out. I have no idea. But the point is that if there's a bias between automation and back testing, you can probably find a flavor of the DC that you can still put on and still might fit your bias.
You hit a great, it's vanilla to me. It's vanilla chocolate. Like you pointed out at the beginning, whether you do this delta, whether you do this, they all win. If someone wants to be more picky, the bottom line is all those different variations that you went over, Matt, at the beginning, they all won, right? I mean, they all won.
I've got them all on my screen. Yeah.
And I think that's the key. Don't let CPI or PP, unless it's clearly with the data, you need to be in, right? And most people miss opportunities for they're so focused on what happened in the market. And that's where you get paralyzed with emotion. A month or a month and a half, they're still living April 8th, right? Or whatever that period, when the last 3 weeks, we've been relatively, obviously I keep mentioning the Friday, or what was the big gap, that Monday, Friday thing.
Yeah. Friday, Monday we had, yep.
But overall for, calendars and stuff, they've been pretty done well.
Oh,
and I think they'll continue on that. And so this parallel, that's where I think the mechanical, it gets you in.
Well,
right.
And so here's another point on that. So this is an extreme example. There's nothing on this show is financial advice, as everybody knows, but this is certainly an example. Troy, run that back test for me. We're going to break a rule and run some live back tests. Run that back test with 5 delta on the put and 20 delta on the call. And so here's the point. Like if somebody was super worried, maybe they were unreasonably long delta, and they wanted a back test that wasn't unreasonably long delta. This has an 8.9% capture rate and wins 2/3 of the time.
Yeah.
So now, how many times does it win to the put? I don't know. Probably not that many.
Yeah.
And you've got a wide tent here. So the possibility of getting crushed and it dying is pretty significant. But if you search for, it's only one above delta 3 times, which above delta would be to a downside exit. But the point is that if you were super worried about the market going down, this idea could inspire you to take a back test and iterate on that until you as a user found one that made sense for your portfolio. Because this is kind of ridiculous that a DC with a 5 delta put is still positive expectancy. But to the point, this would give you a lot of room to the downside, to where if somebody was super nervous and had, they felt like they were too long delta or whatever. Well, take this world-class back tester and find a back test that would maybe give you a little bit of a result you're looking for if you did have one of those big moves to the downside. Because this is crazy to me that this back test has any sort of positive expectancy, yet it's won 2 out of 3 times in the last 3 years. And your average winners are about the same as your average losers.
Yeah, that's a good point.
What do you think, Troy?
Well, let's model it out for a second. So that's all right, because I know with DCs sometimes it can be confusing. So this is the 25 delta put, 15 delta call.
Yes.
DC. And I want you to see, this white line is kind of the current price. Let's play it out. And when you see this, first of all, you see, okay, these 2 kind of big tents or triangles, however you want to do it.
Mountains. My
mountains,
house
yeah.
is between those two hills.
That's right. We live in a holler of death with the DC. That's our fear. And as you play this out through time, you're going to gain value. I'm doing this real slow, but I just want you to keep your eye on the current price. Okay, that white line. What's happening as time's going by? Well, as time's going by, we're still good in value, but the value's going down about right here because we have these break-evens that suddenly popped up, right? These break-evens have suddenly popped up, which is the tent of death, the valley of death.
Sea of death, yeah.
Sea of death, yeah. So when you look at this, what you realize with this is you don't need it to go down too much. You need it to go up a little bit, but because it's a trending market, normally we will trend up, right? And I think that's a helpful way to look at it. When you look at the delta of it, this is where it gets a little interesting. You go, okay, your deltas are adjusting through time, right? Where your deltas are going up, and then it's forming a line. That's the beauty of options, is that's all math, right?
Yeah.
Okay, well, how's your theta working in this? Well, because this is a short-term trade, it's actually hard to model that theta, but your positive theta in general, and then as time goes on, you actually are losing theta if we don't get out of that valley, right? And so the whole point with all of that is to say the Greeks are really important in these type of trades, but because it's a short-term trade, they don't have forever to work in your favor one way or another. And so that's thus, options are priced, for efficiency. And so a 15 delta with 1 day is a 15 delta is very different from a 15 delta with 3 day.
Yeah.
And so you don't need it to move. I mean, you look at this, theoretically a 5-point move, 7-point move is max profit for you to the downside. Okay. We needed to move about 10 points to get max profit to the upside.
Yeah.
But here's the beauty of the test. And let's go back to that. Let's I'm going brain dead here for a second. Sorry.
That's
Let's go
okay.
back to this.
People are asking us to provide modeling on OO right now in the chat. So
friends.
That's maybe a separate show.
So here's the exit. You are exiting the trade at 230. You're getting out because we have assignment risks. This is not a ride or die. You're getting out to make sure that you don't get hurt and don't get 400,000 shares of Qs.
Yeah.
And then we're using leg deltas. And on the leg deltas, how we're doing this is the 25 delta put, when it goes to 60, above 60 delta, we're getting out. In the call, when we're going below 60, we're going out. So let's go back to this real quick and look at this. So on this, let's go back to delta. When are you getting out? You're getting out near the end. And this isn't going to model it correctly, but that's okay. You're getting out. Basically, these 60 deltas are near the end.
Yeah.
And so you're very rarely going to get out really early in this trade, but it's not a trade that lasts long in either direction. So you're fine with that. Does that make sense at all?
Yeah.
It does. Can you talk about the challenge in modeling? Like, I'll just say it like this. One of the things that I've observed is people like to model trades before they put them on. And a lot of times we've had this discussion. I say a lot because over 3 years, it's come up multiple times on the Discord. And somebody will say, I modeled the DC and there's no chance of it winning. And so I skipped it. And then the DC wins 60% profit or whatever, Yeah. And I think it's an important conversation because the trick in modeling DCs is what makes them different from modeling a credit spread or debit spread. Like if you're just buying a call debit spread or you're selling an iron condor, is if you're testing that to expiration, a lot of folks are less worried about the Greeks on an iron condor, but with the DC, when you model a Greek, when you model a DC, there are DCs, if you model them, that will look A, this will never win. B, this will never lose. And the correct answer is C, both A and B are incorrect. So on the multiple guess choice test, you pick C. These are both incorrect, because the trick in modeling DCs is that they are dynamic and the Greeks change. So over time, especially as vol changes through the life of the DC, it will drastically affect how the model looks.
Yeah.
Therefore, given the choice between backtesting a DC and modeling a DC, folks who maybe haven't backtested as much don't understand why you would trade one when they've only modeled the DC.
Yeah. And it's getting at the world of, go through this every day, you know, theoretical Greeks versus actual Greeks. I mean, you look at theta, we'll look at a calendar and I'll look at the theta and I'll say, you're getting 15% P&L on your theta a day. Now I said, that's a wonderful thing, but it's not real, right? If you trade these and you get 15%, you let me know, but you don't get them. So I think it's the, first of all, realizing that. And second, when you model, you know, when people bring up a tasty trade or think or swim, you know, it's again, it's theoretical, but they're not changing the volatility for you. So I think it has to be an understanding of different things as you model. Are you modeling it right? But I think a good exercise for people, I mean, for me, this has helped, and I think it's helped people over the years, is, you know, write down when you're doing when you're learning a double count. Obviously, if you've done it a while, you kind of know how they work, but write down the volatility of your longs, write down the implied volatility of your shorts at the beginning of the trade, write what they are. And then you can see when, because then you have all the information. You've got the implied volatility of your shorts and your longs. You've got the price you put on the double calendar, and then you have the time or whatever. But then you can kind of see, well, wait, I'm getting killed. Well, we haven't moved that much in price. What has happened? Yeah, a lazy way is just looking, okay, VIX is down, but that doesn't always happen. I've seen VIX go down, and I'm making money. So it's really, you know, VIX does not represent your 4 strikes in a double calendar, and you need to look at. So I think if you really want to get under the engine of the double calendar, monitor just for a couple months, look at those, the implied volatility, see how those act. And I think, I think that helps. But again, I think in the world of modeling, you know, it doesn't automate, you know, and the other thing is when you see in modeling, like on Think or Swim, you know, you lower the volatility 2 points or something.
Yeah.
Well, does that happen in real life? No. I mean, your longs may come down a half a point, your shorts may come down a point, right? So there the VIX is going down, but you're making money. Why? Your shorts, they destroyed the shorts. You know, follow this weekend, right? They're coming into Friday. The market makers are going to pound those short-term options, right? Because you got a 3-day weekend. So if your shorts go down more than your longs, even in a VIX going down, it could help your DC. So, I mean, it's just, you know, and it's not an easy concept. Wouldn't you agree, guys? Understanding Vega and how that works because every strike is different, right? It'd be easy if Vega is saying if the volatility of all 4 of your options in a double calendar goes down a point, you'd lose what the Vega says. But show me an instance where that has actually happened.
Yeah.
You know, it doesn't.
The thing with that, with the modeling, I fancy myself a little developer of modeling sometimes. And I think one of the hardest things is people don't remember, and this is the easiest way to remember this. It's a model.
That's right.
And that sounds like I'm being pedantic, but it's most modeling tools are using Black-Scholes, which is appropriate for what they're using, or a variation of Black-Scholes to account for volatility. And Black-Scholes cannot account for vol correctly fundamentally because vol is dynamic.
That's right.
Blackfisher assumes a linear vol when vol is not linear, and so you the perfect example of this in my mind is if you put a DC on and you're targeting like the Fed day, you say vol's going to be sticky and I want vol to go down after the Fed and I'm going to buy the next day or something like that. So you're trying to be strategic. What you'll notice a lot of times, I've had this happen, is let's say you put it on at 350. I've seen a DC trade lose 80% of its value in 10 minutes the day before, which is antithetical to what it should do. Why are they doing that? Because they're taking vol out before the Fed announcement.
Yeah.
And then I've seen the next day it reinflate 100%. The next morning it's up 100%. That's really hard to model because it's really hard to account for what they're doing to the vols throughout the day to adjust for events. Yeah. And so, listen, last thing I'll say real quick. I showed this yesterday. I'll show this again today. With this test, we talk about all the time, that's one contract. So you're not accounting for sequence risk. Well, this is what that trade looks like if you do 100% port. Don't ever do a full 100% port on anything, except for your love for your spouse or something like that. Full port your love for your spouse. But besides that, don't do this. But to show it off, the point of it, the trade works, right? The trade works for larger size, much larger drawdown, and you have to account for that. But I think it's important to remember, what we're showing you is not. There are plenty of tests that only work because it's one contract, and it doesn't work as soon as you get to 3 contracts. This is not one of those trades. This is, to Matt's point earlier, you can have confidence in this type of trade. This is not financial advice, but you have confidence.
There were people who were modeling out the trades yesterday. Shout out to the community Discord. I saw somebody model out the trade they were like, I want to beat this test up. They put 3 cents exit slippage, 3 cents entry slippage, full port. I mean, got it to a ridiculous CAGR, but the point is, there's something here to mine. Like there's some good ideas here.
And bottom line is, this is a high probability trade.
Yeah,
it's a high probability trade, and because you're selling, regardless of the deltas, you're selling somewhere between a 15 and a 25. So you're getting high probability trade. You have a lot of room, and to me, the key is if you have because you have high probability, as long as you have decent rails on, so you don't screw it up, right? If you have decent rails on and rails just appropriate that you don't get too far past the shorts, right? That too far, it's going to work, right? And I think that's the wonderful thing where, what I love about the back testing is, again, I used to think or swim, which I think is the most sophisticated one out there in terms of a lot of the order types they can do.
Yeah.
Well, they can't do anything like putting, get out when the long short ratio.
Right.
And I mean, that's like Star Trek to them. And I think having those really good, I don't think people appreciate having those kind of, I call it, professional risk management rails that can help you lock in that you've got a very high probability rate and get out. And I like it, right? Because that's really the whole problem in DCs is if it moves too far. Yes, volatility can be a problem, but I'm always going to be more worried about the price risk. And as Matt said, people are trying to beat these things up, and it's a good trade. It's a good trade.
And to that point, may your trades be good today, as Spock would say. I don't know how to do that. I'm not really good at that.
As I get older, I don't know if I can do this.
I know. I'm afraid my hand's going to lock. Anyway, guys, good trading. We'll be back tomorrow with more DCs. We got 3 more DCs to show you this week.
What a week.
And listen, they're not all 1-2s, fellas. They're not all 1-3s.
Yeah.
Throwing that out there. We're going to show some long dated ones.
Okay.
So, all right, guys, have a good week. Have a good week and a good day. And I'll see you tomorrow.